this is Shubham from Monist View, and today in this podcast we will discuss various types of risk as a derivative trader we undertook while dealing in Indian Stock Exchange. Here we are basically going to analyze risk with past examples as well as we will learn how to avoid it. So let's discuss one by one what is the reason behind this. On 2nd September 2021 we had witnessed some freak trade in Bank Nifty index option chain. The Bank Nifty option at a strike of a 37,100 put with expiry on 9 September 2021 hit day high of rupees 1921 rupees, which is really insane. It is a classic case of a front running from either a prop desk or a professional trader with executing algorithm with jackpot. Such cases are increasing in recent time with lots of false breakouts in individual stock level. Let's discuss some of these examples one by one. The first risk is use gap up or gap down. This risk is for overnight position for a trader and mostly for the naked position. On 18th May 2009 market opened at 9:55 am as this was the market opening time at that time, and Nifty immediately hit a 20% upper circuit, and around 10 am the market were frozen. So the markets were open only for around 5 to 6 minutes, and there are many such instances of overnight gap ups or gap down previously. So what is the learning from this example is position sizing is matters. You should take only those position overnight where you can easily make out money but you don't have any stress, as well as you should hedge your overnight position. You should not go with a naked position as anything can happen in the market, and these are such a black swan events. The second risk is a Vega risk. What is a Vega? Vega measures the risk of changes in implied volatility or the forward-looking expected volatility of the underlying asset price. On 21st August 2015, the Indian market declined close to 5.92% and Nifty around 490 points. But something unusual happened on that day. Far out of money call options shot up in spite of such a huge fall. In India weeks, which showed general volatility, market it shot up by 64%. So basically the market has shown a directional move, but despite that the option prices are not getting down because of a volatility which the public are expecting. So what is the learning? The best way is to make a system which can manage a high volatility. Here the incidents or any news can shake the market. So prepare your system which can handle little bit of higher volatility. The third risk is a Gama risk. Gama measures delta's rate of change over time as well as rate of change in the underlying assets. It is basically a risk which carries through a different forms of changes in the price of a delta range. On September 2019, which was an expiry day of 26 September, the 30,000 call option of a Bank Nifty index went from rupees 50 to rupees 1000 plus in a minute and eventually closed at zero. Many such instances of Gama risk on expiry day is becoming usual since the leverage tranche introduced by SEBI in recent times. So these are basically the stop loss which is put by the retail traders in their system. How to avoid such losses? You have only one option, and that is proper stop loss in the system. You should always go with a limit loss where your SL is the limit. If you put your SL at a market level, it can hit at any point of time. The fourth risk is false breakout and false crash. On 31st May 2019, flash crash in Bank Nifty of 1000 points has seen. That was the Friday, and the high of a Bank Nifty was 31,783 points and the low of the index was 30,623 points. Such a flash crash is being seen in many stocks as well as other indices. This happens in a stock level, but it is rare to happen in the index due to an index trade in huge volume. So what is the learning out here? Position sizing is the best for this, and if you are holding an overnight position, then pyramiding of your winning trades is the best way to deal with such kind of breakouts and false crash. The fifth risk is a black swan risk. A black swan is an unpredictable event that is beyond what is normally expected of a situation and has potentially served consequences. On 13 March 2020, Nifty hit 10% lower circuit and trading was halted because of COVID-19 issue, and it is halted for 45 minutes. And when the circuits are open, market rallied and closed around 4% in a green. Sensex, which was 3,300 points down in the morning, at the end of the day they are 1,300 points in a positive. To avoid such kind of risk, two most important thing is position sizing and second, full hedge positions. The sixth risk which we carry as a trader is algorithm or execution risk. Algorithmic trading is a process of executing order utilizing automated and pre-programmed trading instruction to account for variables such as price, timing, volume, etc. It's basically machine learning through whatever the system which we follow. On August 1, 2012, due to algorithm issue, Knight Capital, an American global financial service firm, did $397 million shares trading and assume it is a net long position in 80 stock for approximately 3.5 millions, as well as a net short position in 74 stocks of approximately 3.15 billion. Knight lost over $640 millions in this trade. It is basically an executional blunder. So to avoid the risk, the best learning from this example is to test your system very well before deploying in a market. Seventh risk which we as a trader face is an exchange issue. This issue is directly related with the system of exchanges. Any interpreted or damaged flow of information can cause in delay or total loss of data to trader. On 14th Feb 2021, NSE faced a technical glitch for the entire day and the trading was halted. This caused lot of issues and completely making M2M fluctuations for the trader. As far as trader is concerned, we are not able to handle this issue because it's all the information technology based on the exchange side. The next risk is price can also trade below zero as well. Technically, price cannot be a negative, but fundamentally price of a commodity can go zero if the cost of carrying is higher than the offer price. On 21st April 2020, a historic drop occurred when the price of a West Texas intermediate crude dropped by almost 300%, trading at around negative $37 per barrel. This is basically the carrying cost of the oil, and that's why it's called that commodity markets are real markets and they can make you or break you. The last risk which as a trader we deal is a liquidity risk. Liquidity risk occurs when an individual investor, business or financial institution cannot meet its short-term debt obligations, or in case of a trader as we speak, slippages happens because of non-availability of a counterpart trader. This is my personal experience while trading with new index Nifty Fin Services, which is introduced by regulator recently. On 15th April 2021, due to a less liquidity, my MTM changes from rupees 1873 for only one lot. So this is what my loss is for one lot because of these slippages. So what is the learning to avoid this liquidity risk? Trade where there is a volume. At the end, we want to give the credit to Mr. Sourabh Sisodia because these are the examples given by Mr. Sourabh Sisodia in his tweet thread. We have taken majority of example from his thread, so huge shout out to Mr. Sourabh Sisodia. To end, what is the bottom line? Trading derivative is not a zero sum game and it comes with a various risks, but we need to prepare for everything. So it is important to be aware of what we are doing, learn continuously and be prepared with full hedge. If you want to read the full article, the link is in the description. Thank you for joining with us for this podcast.